Right now, in 2026, the three main structures Australian business owners use to build wealth are all changing at the same time. Super is being taxed differently above $3 million. Trusts are under more ATO scrutiny than they've ever been before. And the CGT discount that made holding investments personally worthwhile is about to shrink. Most people are still thinking about each of those separately, which means they're making decisions about where their wealth sits without seeing the full picture. Today, I want to show you how all three interact under 2026 rules, because when you actually map it out, a clear hierarchy emerges. And for most business owners I work with, the answer is different from what they'd expect. For about 20 years, the standard advice for Australian business owners was pretty consistent. Max out your super first, because 15% tax going in is hard to beat. Use a family trust for flexibility, because you could distribute income to whoever in your family was on the lowest tax rate. And use a company for trading, but not much else, because holding investments personally or in a trust gave you access to the 50% CGT discount that a company couldn't touch. That advice wasn't wrong. Each part of it made sense given the rules at the time. Super had no real ceiling on how tax efficient it could be. Trust distributions were genuinely flexible, and the gap between a 24.5% effective CGT rate personally and 30% in a company was real enough that holding investments outside the company was the right call. The problem isn't that the advice was bad. The problem is that all three of those assumptions have changed, and they've changed at the same time. The first shift is Division 296. From 1 July 2026, super balances above $3 million face an additional 15% tax on earnings, taking the total rate to 30% on that portion. The part that catches people off guard is the trajectory. If you're 45 today and you've got $800,000 in super and you're making contributions, you could be looking at $2.5 to $3 million by your late 50s. The problem doesn't feel urgent right now, but the decisions you make about where surplus profits go today are exactly what determines whether you end up on the wrong side of that threshold. The second shift is what's happening to trusts. The ATO has named income splitting through trusts as one of its 7 compliance targets for 2026. Section 100A is being used to go after distributions to family members where the money doesn't genuinely end up with that person. And the Bendel case heading to the High Court could create significant flow-on consequences for thousands of small business owners. The flexibility that made trust the default recommendation has been systematically restricted. The third shift is the CGT discount. Right now, at the top marginal tax rate, your effective CGT rate is only 24.5%. If the government decide to lower the discount to 33%, it goes to 32.2%. At 25% discount, it's 35.8%. Both of those are above the 30% company tax rate. So the argument that kept investments out of companies for 2 decades has either closed or flipped entirely. So if super has a ceiling, trusts are a compliance risk, and the CGT discount argument is dissolving, the question is, where does the money actually go? Well, my challenge for you today is to stop picking just one structure, because that's exactly what's been limiting you. And with all three of these changes hitting at once, it's more costly than ever. Here's the thing. Division 296 only hurts if your wealth is in super. The trust crackdown only hurts if your trust is doing the investing and the distributing. The CGT discount shrinking only hurts if you've been holding investments personally or in a trust, because you thought that was a smart move. Every single one of those changes is targeting people who are over-relying on one structure. But if you've got all three working together as a system, each one doing its specific job, none of them carrying more weight than they should, these changes barely touch you. And when the system is set up correctly, 2026 looks a lot less scary than the headlines might suggest. Let me show you what I mean. Your trading company runs the business. That's where the revenue comes in, where you pay your wages, where the business operates day to day. Now, above that, you have a family trust that owns the shares of the trading company. I know I've been critical of trusts, and I'll stand by that when it comes to using them for investing or distributing income to family members, because that's where all the ATO risk lives right now. But a trust as a shareholder is a different thing entirely. The trust doesn't do any investing, doesn't carry on the business. It just holds the shares. And the reason that matters is asset protection. If somebody sues your business and wins, they can come after the assets of the business owner. But if a trust owns the shares rather than you personally, there's a legal separation between the person taking the risk and the person controlling the assets. The trust also doesn't have a lifespan the way a person does, which makes passing wealth to the next generation significantly cleaner. So the trust earns its place in this system, just not in the role most people have been using it for. When the trading company makes a profit, you pay yourself and your spouse what you need to live on, and the surplus gets distributed across to a separate investment company. We call it a bucket company because that's essentially what it is. A company that sits alongside your trading company and catches the surplus profits, taxing them at 30% or sometimes 25%. Instead of you taking that money out personally and paying up to 47% tax, the money stays inside the company or gets invested. And because you're paying less tax on the way in, you've got significantly more capital compounding from day one. And unlike a trust, there's no requirement to distribute the income every year. So the money just keeps building inside the structure until you're ready to access it. Super sits alongside all of this, funded by your concessional contributions every year, doing what Super does best. Low tax on the way in, long-term compounding, and then a tax-free pension when you get there. Now, inside Super, you've got a choice about how you hold it. You could set up a self-managed super fund if you want more control over where the money is invested, and there are situations where that makes sense. But I actually did a full video on this recently, and my honest position is that most business owners don't need one. My firm is closing more SMSFs than we're opening right now, and I shut down my own SMSF because the compliance burden just wasn't worth it for what I was getting out of it. For most people, a wrap account through an advisor or a direct investment option inside a retail or industry fund gives you enough control over your investment selection without the annual audit, the trustee resolutions, and the $3,000 to $4,000 a year in compliance fees. So that's how they all work together. I'll quickly show you how I mapped this out for one of my clients. They were a husband and wife running a service-based business. When they came to see me, they had $500,000 in surplus profits after wages, both on the top marginal tax rate, $800,000 combined in super, and they were 45 years old. Pretty typical client for us. Under the old playbook, they were maximizing super contributions, $30,000 each, which was saving them roughly $19,000 in tax. The remaining $440,000 was getting distributed through a family trust, but because both of them are already on the top marginal tax rate from their wages, most of that $440,000 was getting taxed at 47%. So realistically, they were walking away with around $240,000 to invest after tax. And because the trust had to distribute everything by 30 June, nothing was being retained inside the structure, compounding for the next year. When we moved them over to the right system, the remaining $440,000 got distributed from the trading company to the bucket company, taxed at 25%. So $110,000 went to tax and $330,000 stayed inside the company. So essentially, they had $90,000 more capital invested from year one compared to what they were doing before. At 8% annual growth, that $90,000 difference just from the first year compounds to around $420,000 more wealth over 20 years. And we were doing this for them every single year. Then, when they stop working and their personal income drops, they can draw fully franked dividends of around $140,000 each with little or no tax to pay because the company has already paid tax and those franking credits come back to them. So if you're generating surplus profits and you haven't looked at how your super, your trust, and your company are working together under the 2026 rules, that's a conversation worth having. If you want to go deeper on any of the individual pieces, I've done full breakdowns on bucket companies, the CGT changes, trusts versus companies, and SMSFs. I'll link them all here now. See you in the next one.